Silicon Valley Bank was a commercial bank headquartered in Santa Clara, California, that was founded in 1983. SVB was the 16th largest bank in the United States at the time of its demise, with a heavy focus on serving companies and individuals in the technology industry. SVB funded nearly half of all venture capital-backed healthcare and technology companies in the United States. The bank's clients have included Airbnb, Cisco, Fitbit, Pinterest, and Block, Inc. In addition to financing venture-backed companies, SVB was well known as a source of private banking, personal credit lines, and mortgages to tech entrepreneurs, and specialized lending money to higher-risk new companies. Silicon Valley Bank required that those borrowing from the bank have an exclusive relationship with the bank. Until the 9th of March, 2023. The California Department of Financial Protection and Innovation had determined SVB to be in sound financial condition. However, an increasing amount of short sellers had begun targeting the firm earlier on in the year. On March 10, 2023, just hours prior to government intervention, SVB employees received their annual bonuses. According to the previous call report made at the end of 2022, SVB held a total of $209 billion in assets with $175.5 billion in deposits. Estimated figures showed that 86.4% of those deposits were uninsured. At the start of 2021, bank deposits had increased from the previous year due to the impact of the pandemic on science and technology. Most of these deposits were invested in longer-term treasury bonds, in an effort to gain a higher return on investment than with shorter-term bonds. However, rising interest rates caused these long-term bonds to lose value as they became less attractive investments. So, in April 2022, SVB's chief risk officer stepped down and was not replaced until January 2023, coinciding with this period of increased rates. At the end of 2022, the bank held a $117 billion bond portfolio in both its held-to-maturity and available-for-sale portfolios. Since no hedge was put in place against interest rate risk for bonds held to maturity, SVB instead invested in shorter-term bonds. However, they did hedge their available-for-sale portfolio through $15.2 billion worth of interest rate swaps. Withdrawals from deposits began as startup companies needed money for private financing due to decreasing funds, and layoffs in the tech sector beginning in 2022. SVB then realized gains by unwinding part of its swaps portfolio, worth $11 billion, before selling all available securities for cash flow at a loss of $1.8 billion during January 2023. The timing was questioned as it followed Silvergate Bank's winding down operations for their cryptocurrency users, and it was suggested that private funding should have been lined up ahead of time. However, no changes were made due to this issue. In 2021, a Federal Reserve review of the bank revealed several deficiencies in its risk management procedures. Unfortunately, the bank failed to address the 6 citations issued by the Fed and was subsequently placed under a full supervisory review in July 2022. During autumn, San Francisco Fed officials arranged a meeting with SVB's senior leaders to assess their ability to raise cash in an emergency and evaluate potential exposure to losses as interest rates began to rise. Eventually, it was determined that SVB had been using erroneous models that misled their officers into believing an increase in interest rates would help stabilize their financial state. By early 2023, the Fed had placed SVB into a horizontal review of its risk management operations. Moody's Investors Service notified SVB Financial Group, the company's holding company, that they were facing a double downgrade of their credit rating due to unrealized losses only days before the collapse. Subsequently, on March 8, SVB announced it had sold over $21 billion worth of investments and borrowed $15 billion from various sources. The bank also declared an emergency sale of stocks for up to $2.25 billion, including $500 million for General Atlantic. Although JP Morgan Chase and Bank of America refused any offer of acquiring the bank, Moody's still downgraded them on March 8 regardless. Alarmed by these events, executives at venture capital firms including Peter Thiel's Founders Fund and Union Square Ventures, along with Coatue Management, urged their portfolio companies to withdraw all deposits from SVB before it was too late. In response, Founders Fund withdrew all funds they possessed by morning on March 9, while customers ultimately withdrew around $42 billion by close of business, leaving the bank with a negative balance of almost $1 billion, $958 million. Capital transferred from SVB customers went directly towards Brex, JP Morgan Chase, Morgan Stanley and First Republic Bank. Consequently, this caused the value of shares in SVB fall significantly until trading halted on March 10 morning. It has been noted that Greg Becker, CEO of SVB Financial Group, sold 12,451 shares worth $3.6 million via executive trading plan put forward January 26 under Rule 10b-51. This regulation has been criticized for allowing insider trading with only minimal punishment for those who break it. Though beginning April 1 next year there will be new regulations in place requiring at least 90 days cooling period before any executive trading plans can be initiated again. On March 13, 2023, HSBC UK announced that it had reached an agreement to acquire Silicon Valley Bank UK for £1. With no cost to taxpayers and all deposits fully protected. Subsequently, on March 26, the FDIC declared that First Citizens Bancshares would acquire SVB's commercial banking business. As part of the agreement, First Citizens purchased approximately $119 billion in deposits and $72 billion of discounted SVB loans minus $16.5 billion, with around $90 billion of SVB's securities still being retained in receivership. The FDIC will be gaining equity appreciation rights worth around $500 million linked to First Citizens shares. On the day following the acquisition, SVB's 17 branches will reopen under First Citizens brand with all depositors now being depositors of First Citizens. The FDIC